everybody. This is Josh Brockwell with Azzad Asset Management. Thank you all for joining us today. We gave you a few minutes to trickle in here. I think we're reaching critical capacity or mass now, so we'll go ahead and get started. So thanks again for being here. Welcome to Azzad Asset Management's 2018 Investment Outlook webinar. Today we'll be hearing from Mr. Christian Greiner, who's the Azzad Ethical Fund Portfolio Manager. He's also with Ziegler Capital Management, and he'll be talking to us today about what we can expect in the new year. Christian will be joining us in just a moment, momentarily, to offer up his perspective on matters. Just to get through the housekeeping, the other presenter will be me. I'm Josh Brockwell, Investment Communications Director here at Azzad Asset Management. As for today's agenda, just to give you some ideas to how we'll proceed with today's session, we'll start with a level set about where we are. Then we'll explore the recent tax legislation, which a lot of folks believe is going to have quite the impact on the economy. We'll get Christian's thoughts on that. And then we'll take a look at the economy and its prospects for growth in light of the tax legislation, as well as some other factors. We'll talk about risks to the market, and we'll have a concluding note on inequality in America. So let's now turn to the first section of today's presentation. And actually, before we do that, I will say at the outset, I should mention that market conditions, good or bad, shouldn't dictate your risk appetite as an investor. And you should really stick to a long-term financial plan. This is just sort of the caveat before we begin. If you don't have a long-term financial plan, we're here to help you with that, just as an FYI. So with that, let's start today's first section, which is where the market currently stands. And that's also going to include a look back very quickly at 2017. So we'll bring in Christian Greiner joining us today from Chicago. Christian, are you there?
Hi, Josh, and hi, everybody. I'm glad to be here from balmy Chicago today. It's 20 degrees, so it's a heat wave. So to start off with 2017, I don't think you need me or anyone else to tell you that it was really a great year for U.S. equities, with double-digit % gains for most investment styles. The S&P 500 returned a heady 21.8%. We saw growth reestablish itself after an off year in 2016. Growth outperformed value by about 16% or so on the year, and that's continuing what has been really a robust growth outperformance that's been going on for over a decade. And that's actually something we've been watching very closely here in our offices. Take a look at some other investment themes that mattered. Large cap outperformed small, with the Russell 2000 up only 14.6%, still a pretty good year. On a sector basis, as anybody that could read the headlines could say, it was a great year for tech stocks, but materials and healthcare also really did well. It was a disappointing year for telecoms and energy. Those sectors actually posted slight losses. In terms of the broader equity markets, it was a good year to have some foreign market exposure, with developed markets outside the U.S. returning 25.7% and emerging markets returning above 37%. So this little stat bank here is a nice piece from MarketWatch, and it shows that the start to 2018 has been pretty hot, and it bodes well for the coming rest of the year. So the old market adage is, as go the first 5 days in January, so goes the year in terms of market returns. That is, if we have a positive first 5 trading days for the market should finish the year higher. This effect appears to be especially strong when the market has a really strong first week. In the post-World War II period, when the S&P 500 has posted a 2% or better gain, it's only had a sub 10% gain twice. One of those years contained the 1987 crash.
Okay, Christian, thank you. So we've established that we've had a great start to the year so far, 2018. Many have said that part of that great start is thanks in part to the tax legislation that was passed at the end of 2017. So, care to comment?
Oh, I would be happy to. So the news that drove really this latest upward move that we've seen over the last couple months is the passage of the tax reform legislation. This has had several implications for the market. The first and most visible one of these is that it lowers the corporate tax rate from 35% down to 21%. And that brings the US more in line with its developed nation peers. It's also reduced in the near term income tax rates for the majority of taxpayers. Now, the effects and magnitude of these gains based on income levels, where someone lives, their type of income, those are going to be hotly debated. And it's really something to keep an eye on in 2018. But all of this should have a possible boost to GDP as consumers and businesses go out and spend those gains, everything else held equal. So most credible sources that I've seen put this gain for the GDP around 0.5%. It's a 0.5% boost to GDP. But that range of estimates has been from just 0.2%, and really the highest one I've seen has been a little over 1%. So this should lead to a rise in spending on capital goods as well. There's a write-down provision in the tax bill that makes it more attractive for companies to go out and buy new machines to increase productivity or expand operations. They get to write off that expense on their taxes immediately instead of taking their time writing that off over years as machinery is used up. So this next graphic is from JP Morgan, and it's probably the best representation I've seen on the effects of the tax reform legislation and how it really could affect S&P 500 earnings. And this was a debate the markets was having throughout most of 2017, the magnitude that this would have on corporate earnings. So the reduction in the corporate tax rate gives earnings a big boost. And that's offset by some small losses due to reduced interest deductibility and a tax hit when companies actually repatriate those foreign earnings. Think about that headline about Apple's tax bill yesterday when they're finally bring these earnings back to the US. However, earnings per share rise once companies put that cash to work in the form of maybe stock buybacks. The cash flow profile, which is important to our process at Ziegler, increases when companies can immediately expense all their capital expenditures for tax purposes. All in all, it adds about $10 per what you would call an S&P share, or really a 7% boost to earnings.
Okay, so Christian, could you give our listeners some indication as to winners and losers in this bill, or expected winners and losers?
Yes, so that's really an interesting exercise that we've been having here. We've put together a list here, and by no means is this a definitive list of who could benefit from this new legislation. So possible winners include companies with primarily US-based operations and US-based customers. A lot of market observers say that this will be mid-cap stocks and small-cap stocks because traditionally these stocks have more domestic focuses than large-cap stocks, which have increased international operations. So these mid and small-cap stocks will be big beneficiaries. Capital goods providers, we talked a little bit about that before. They're going to see increased demand for their goods that can now be expensed and should be a big boost to the revenue, and that will hit the bottom line. There's also a line of thinking that auto stocks will benefit from the lower tax rate and the ability to bring foreign earnings in, plus a possible increase in domestic demand. And one other one I'd like to talk about is pharmaceutical stocks. Pharmaceutical stocks could benefit, of course, from the repatriation of earnings. But that will also lead possibly to a merger wave in this space. 2017, we didn't see a lot of mergers within these biopharma stocks. And so far, so what we've seen in 2018 is that we've really started to see an increase in these merger announcements and merger rumors within the biotech and pharma space. So what we also need to take a look at, of course, is who are the possible losers of this. And this is relative. You know, some of these names will still do pretty well. One of these, of course, will be stocks with lower tax rates. And what you have to think about is tech and healthcare stocks, which really weren't paying as high taxes as consumer discretionary and industrial names on average. And we saw some of them sell off in November and December as it looked like this tax legislation would happen. Another one to take a look at are companies with high leverage. This bill puts a limit on how much debt you can write off as a percent of your income as a company. For some of these companies, that means that they're going to have reduced profitability. Another one to consider are healthcare service companies. Within this bill was something that effectively or was trying to repeal the ACA individual mandate, that would mean reduced volumes for hospitals and other groups, and that could affect their earnings as well. And finally, one other one to consider are unprofitable energy companies. These are companies that still haven't gotten their way out of the pain that we saw in the energy space from the oil and gas price declines. They need to become profitable before we can see them really benefit from all of this.
Okay, so now that we talked about tax bill winners and losers, or potential winners and potential losers, walk us through the economic backdrop that's led to the bull market that we're currently experiencing in equities, if you would.
Well, sure. So the first thing I sort of want to talk about is that really a lot of the elevated multiples that we see in the stock market right now, part of them is that it's a result of confidence in the U.S. economy. So the U.S. economy appears to be on solid footing. We're approaching full employment if we're not there already. American household balance sheets are in good shape. American businesses, their balance sheets are in really good shape as well. They had a lot of cash on their balance sheets. And now they just received a sizable fiscal stimulus in the form of this tax reform plan. So all this points to another year of economic expansion. Consensus GDP growth is expected to move up from 2.3% in 2017 to around 2.9% in 2018. Consumer spending is expected to rise 2.8%, and that's a slight boost from 2.6%. Real capital spending, once again helped by that tax bill, is expected to rise by 5.4%, and that's quite a hike from the 4.9% that we saw in 2017. And finally, U.S. export growth rates are expected to rise. But part of that's also because of the recent weakness in the U.S. dollar, and that makes the goods produced here more attractive to overseas consumers. So the question overhanging all of this is, do we see a recession on the horizon? Most economists will say not in 2018. There's a camp that believes that as the Fed tightens interest rates and the economic cycle plays out, we could have one in 2019, but that's really not a consensus view right now. And as we can see with this chart here, it's not just the US that appears to be on solid footing. One of the more underappreciated pushes behind the equity market gains that we've seen here in the US is actually demand from overseas. We're in the middle of a cycle of unprecedented synchronized global growth. The number of countries in a recession has hit an all-time low. So the effects of this on US companies is that foreign markets have the means and appetite for more US-made goods. Right now, about 43% of S&P 500 profits come from overseas sales. Couple this with a weakening US dollar, and it really provides a nice tailwind for US profit growth.
Okay, and now on to market opportunities in light of this economic environment.
So Josh, we did this exercise last year, and really I think it's a good starting point on how to look at the market. So what we're doing is we're taking a look at 20-year average forward PEs, and technology, healthcare, and telecom are trading below the average. As one would expect, when we have a market like this one that has an above average market PE, we have a greater number of sectors that are above the average and could be considered expensive. Energy is one of those. Consumer discretionary, utilities, financials are in there as well. Industrials are now trading expensive relative to history after a strong run in capital goods stocks, as well as transportation stocks. But one thing to remember is that one also has to take a look at earnings growth. Industrials may be expensive here on just a pure PE ratio basis, but if one doesn't think that the effect of tax reform bill is priced into these capital goods producers, there actually might be some opportunity. On the other side, healthcare stocks are predicted to have below historical average earnings growth. You think about the uncertainty around drug prices and legislation, that continues to be a source of uncertainty for the space. So when I was looking through last year's presentation, I came across this slide, and I was really struck at how it probably serves us to bring it back out again. As this bull market starts to move up in the record books in terms of length, but not necessarily potency, it's probably best for us to take a look at how the market traditionally behaves late in the cycle. And late in the cycle, investors are concerned about two things: inflation and rising interest rates. More importantly, how they look to protect their portfolio against the effects of these two forces. Commodities might start to perk up, and companies whose fortunes are tied to those commodities might also see a pickup in share price as well. So with that in mind, investors tend to move away from utilities, which are traditionally interest rate sensitive. They go towards technology and industrial stocks that may benefit from increased capital spending, which happens when companies are flush with cash. They also try to gain some exposure to cyclically sensitive energy and material stocks, as we've mentioned before.
Interesting that tech continues to stay at the top of your list even after leading the way for much of 2017. I'm just noticing that as we go through here.
Yes, I mean, it still is historically cheap, and you do have interesting earnings growth profiles in several of the industries that make up the tech space.
Okay, so that brings us to what investors should be concerned about in light of the picture you've just painted, which overall looks fairly rosy. What should we be worried about, Christian?
Well, you know, when you take a look at a rosy picture, sometimes you have to look a little bit closer to see what might be of a little bit of a concern. And the first concern is one that we debate here most here in our Chicago offices. And where will future gains in the equity market come from? In the past, as we've seen, it's been that PE multiple, that price to earnings multiple. That's continued to rise. And this might be harder to do in the future. One reason is that the accommodative Federal Reserve policies are coming to a gradual and measured end. The Fed has laid out how they will shrink their post-crisis balance sheet down to more manageable levels. They're expected to continue their rate of Fed fund rate hikes. The market is expecting 3 this year, though really 4 is not out of the question. So on top of that, there's evidence that some of the foreign central banks, they're also reassessing their accommodative stances. The rising cost of money, all things else equal, makes stocks less attractive. And one could see PE ratios actually contract because of that. So that would mean that future gains will be increasingly be predicated on the E in that PE equation, rising earnings. We've already seen the effects that tax reform legislation has had on earnings expectations. We also have a pretty healthy economy with strong profit margins and the possibility of a more buoyant consumer who's out there spending those tax cuts. Usually at this time of year, we're sitting around the table and looking at consensus S&P earnings and figuring out how they will track lower as the year goes along. That's just the pattern that they usually take. This is a year when those S&P earnings estimates might also have some upside risk, the risk that they're being underestimated. So the last point to bring up here is that bull markets usually end with a crescendo, with a spike in levels and valuations as the market captures the public interest and everyone feels the need to really be in that market, the fear of missing out. And we could see higher earnings estimates lead to higher multiples as the market approaches its cyclical peak, hitting new highs each and every day. And this is really known as a melt-up. And while we haven't approached these levels, it's a market dynamic to keep in the back of our mind. So a melt-up rally can be caused when a market's gains have been noticed and finally capture the public's imagination. People feel the need to get into the market, chase those prior gains. And the increased investment flows often drive up prices and multiples, leading to the exuberance that we associate with market tops. You think of the tech bubble, things like that. So the chart that I have here is the Association of American Individual Investors Bull Ratio. And that's really a common measure of market sentiment. It measures the percent of investors who are bullish on the US stock market. Since hitting a post-crisis low before the election, it spiked to post-crisis highs, near 60%. For contrarian investors, this is a warning sign. Couple that with near all-time lows on the VIX index, and that's a measure of implied volatility in the options market that's commonly called the fear index. And you get the picture of investors that are maybe being a little too complacent about the risks in the marketplace.
Okay.
So one other thing that we have to consider about is new leadership at the Federal Reserve. The Federal Reserve will be getting new leadership this year, and anytime there's a change in the leadership at the central bank, there's some increased uncertainty that enters the market. And you can argue that the three most important people within the Federal Reserve System have left or will be leaving the Fed this year. But all things considered, this should be or may be a relatively quiet transition. The new Fed chairman, the new slated Fed chairman is Jerome Powell, who's served on the Fed Board of Governors since 2012. The Senate's yet to confirm him. Hopefully we get the vote any day now. The concern is that, once again, as I've said, a lot of experience and leadership is leaving the Fed. Chair Yellen will leave the board the day Powell's sworn in. Highly respected Fed Vice Chairman Stanley Fischer, he left the board on October 2017, and a replacement for him is yet to be nominated. And finally, the New York Fed president, who's always influential in the way that the Fed operates, Fed President Dudley, he'll be stepping down in mid-2018. So this Federal Reserve will be watched in terms of how it continues the course of the balance sheet shrinkage that Yellen laid out. How will they respond to any unexpected effects that the economic data gives them? Will the efforts that the Fed has made over the last decade to be more open and transparent, think about those press conferences, will they continue? Powell dives right into this with his first meeting as chair in March. The market's pricing in a 0.25% rate hike in the key federal funds rate at that meeting.
Alrighty.
So one of the big economic questions that's being asked is this the year that inflation finally consistently picks up above a 2% rate? Market participants are starting to think so. The key fixed income-based measure of future inflation showing that they expect a rise. Market participants expect a rise over 2% this year. So we have to ask ourselves, what's driving this belief? As the economy picks up steam, it's natural for inflation to pick up as economic participants chase that same pool of resources, be it labor or commodities. Where this is most apparent really is within the employment market right now. There's an expectation held by Americans and their CFOs alike that wages are going to increase this year, especially in healthcare, construction, and tech industries. There's some room for this to happen and for companies to maintain healthy profit margins. The percent of corporate profits that wage earners get is still near cycle lows. And this once again goes along with that late cycle playbook for markets. Once inflation starts to rise, investors often rotate their money out of bonds and into equities in an attempt to keep up with that rate of inflation. So one way to take a look at that is this, the Consumer Price Index, the year-over-year change that consumers pay for a basket of goods. This measure's remained at or below 2% for 5 years or so, compared to the 5.6% rise in prices that we saw in 2007 before the financial crisis. The measure that I'm citing here includes food and energy, two areas that have seen some volatility over the last few years. Think about the drop in energy prices in late 2014 and the food price deflation in the early part of 2017. The latest reading on this measure was 2.2%. However, if we see a marked increase in commodity and resource prices and start seeing some wage inflation, we could see increases in these inflation measures pretty quick. And just to break down this graph a little bit more, we see that the prices of goods that Americans buy actually went down on a year-to-year basis for a good number of categories. Only energy, shelter, think of that as really the price of housing, and transportation services saw meaningful above average inflation. For 2018, it's expected that the rate of energy price inflation moderates, housing inflation should rise a little bit more, and food price inflation, now it's actually positive, should remain at those levels. What will be interesting to watch is the price of automobiles as well as apparel. Think of that as an Amazon effect, keeping prices down, if those still decline. So taking all of this, the good news is that after a very prolonged and slow economic recovery, we're hitting what economists call full employment. And that's where an economy where those who want to find it at a reasonable time or effort can do so. You always have some unemployment in an economy due to structural reasons, But as we can see from this graph, this is the headline measure, the U3 measure. We are at those post-crisis cycle lows. One thing to consider, though, is history. And it shows us that when this headline rate dips below 4%, we start really seeing a pickup in the rate of increase in wages and other pricing pressures, two items that can cause issues for corporate earnings.
Okay, Christian, so let me jump in there and ask you to talk to us for a minute about the unemployment rate for those who are underemployed or leaving the labor market out of frustration. We hear about those sorts of things these days. Can you comment on that?
Well, sure. So anytime you mention the unemployment rate, there's those that will mention this chart here, and that's the U6, or real unemployment rate. This gets brought up a lot during a lot more during economic recoveries and election years. The unemployment rate, this unemployment rate that includes discouraged workers who have quit looking for a job and part-time workers looking for full-time employment, the U6 rate is considered by many economists to be the most revealing factor of a country's unemployment situation, since it covers the percentage of labor force that is unemployed, underemployed, and discouraged. So this is important because we want to make sure that we see a broad participation in the economic recovery, something we've really not been so sure that we've had here in this slow recovery. One can argue it's better for an economy's health if you have the broad-based participation in the upside. And that's something we're going to touch on a little bit later here. But for now, what we're seeing is a situation that mirrors what we're seeing with the headline unemployment rate. It appears that people are being drawn back into the workforce. And that at times can push headline unemployment rates higher, that U3 rate that we saw before, as people return to the workforce and come back into that labor pool. So one other thing that I'm a little bit concerned about is the household savings rate. And even though the U.S. consumer has a pretty healthy balance sheet right now in terms of savings, their home values, their investments, there's signs of strain. After the financial crisis, there was a lot of discussion that the American consumer had learned their lesson in terms of housing and consumer debt and found new financial discipline. And what we've seen over the last couple of years is that these savings rates have declined over those last couple of years. There's a belief, of course, that savings is just future consumption and that it's important for the economic cycle that we have some savings to serve as a buffer. So what we're seeing here is just Americans anticipating future raises, as we talked about, that unemployment rate goes below 4% and they think they're going to see a raise, and they're spending them in the now. Are they feeling more confident because of the rise of housing prices? The question is how Americans will treat their raises if real wage increases finally occur. Will we see this savings rate stabilize back up to the 4 to 5% level? Will they go out and spend these raises? And so that brings me to really what we need to watch for here in 2018. It just sort of sum it up for everybody. And the first of these is that U.S. equity valuations continue to rise, but they're really not near the past peaks that we've seen in non-financial crisis market peaks. So tech and healthcare sectors remain cheap on a long-term basis. Tax reform, that'll be a tailwind for 2018 earnings. It'll be interesting really to see in which sectors it plays out the most. Tax reform's effects on different areas of the market. Will it favor businesses with domestic focuses, small caps versus large caps? A lot of people were concerned that the Russell 2000 didn't rally as much as they expected in the second half of the year as these tax reform legislation looked more and more likely to be passed. You know, have these effects already been priced in? One thing we take a look at is that companies with high tax rates or high past tax rates have really rallied pretty strongly here over the last month or so. You know, and really does this greater economic growth take the shine off of growth stocks? Growth stocks may have outperformed value stocks for the last decade or so, basically because growth was scarce. If we see growth become a little bit more scarce, traditionally that means that valuation comes back into vogue. One other thing to consider, of course, is that world economies are on a solid footing. We saw that chart showing that synchronized global growth is occurring, and that's going to be good for U.S. earnings. As the number of countries in a recession really is at a historic low. One thing for us to be concerned about is will inflation and interest rates finally see a meaningful move higher? And more importantly, for a lot of families, will wages keep up with the rise in inflation? And how will the American consumer respond to a larger paycheck if it happens? And one other thing that will be grabbing headlines, of course, is the new Federal Reserve leadership. And are they staying the course? So once again, just to reiterate, currently the market's expecting about 3, maybe 4 rate hikes, depending on economic data. And there's possible concerns over inflation due to full employment and fiscal stimulus, and how the Fed will react to that, and will it change their rate hike schedule?
Yeah, it's interesting to me. One of the things that stands out as I look at that slide, I mean, when you're talking about Fed tightening in light of this fairly massive fiscal stimulus on the policy side, those two things seem to be somewhat contradictory in nature, and it'll be interesting to see how that kind of shakes out.
Yeah, and that's something that people have expressed concern about, is that usually you want to see this type of fiscal stimulus when the economy maybe isn't doing as well, from a cyclical perspective. But as we've seen in the past, this is actually normal, that we see the economy taking off, and to keep the economy going, often governments, not just U.S. governments, other governments do this as well, will add fiscal stimulus just to keep it going.
All right. Well, you mentioned the state of the consumer, and you talked a little bit about wages, and obviously one of the things that we're concerned with at Azzad, one of the things we hear about from our clients and colleagues, is the issue of inequality. And I'd like for you today, if you could, to spend a few minutes at the end of the webinar today talking about this issue of concern and its impact on markets and the economy. A lot of people say that as the rich get richer, the top 1% continues to take a larger share of a nation's wealth, that can actually have longer term, maybe more adverse effects on economic growth. So if you could comment on that.
Well, sure, I'd love to do so. But first, I'd like to give a caveat to everyone that these are more broad issues. There aren't any tangible investment recommendations that come from these topics. These are just really a couple of issues that have market participants talking, and it's really something of interest to all of us. So we take a look here at economic equality. I've given you some headlines here. Nearly a third of American households have nearly 0% in wealth, the most since the U.S. government kept track of this measure since the 1980s. A couple measures here about basically high income earners are controlling a greater amount of wealth, and they're getting a greater amount of the income pie each year. And these statistics are often used as headlines or used to shock. But what we have to do is we have to take a look at these in the entire picture. And in aggregate, they paint a pretty dire picture that wage inequality and long-term wealth inequality is creating an increasingly bifurcated America, separated between the haves and the have-nots. The effects of this economic uncertainty are really just being understood, not only in economic texts, but also in sociological and psychological papers in terms of stress on long-term health of individuals, decision-making of households. But we can also see how this issue has manifested itself in the public consciousness in the form of recent political movements or the candidacies of certain politicians. These issues were at the forefront of the US presidential primaries and general election, and probably will be in future ones. These were at the forefront of issues that drove the Brexit vote and the unexpected result in 2016, and the French election in 2017. These were big issues as well, really just to name a few. So we have a couple graphical representations here. And the first of these is one of the most cited charts when one talks about this issue is usually along this line that was put together by Deutsche Bank Research. And it shows that household wealth in the US has become much more concentrated over the last 40 years. Those that really want to raise the alarm point out that the last time that the top 0.1% held more wealth than the lower 90% was right before the Great Depression. Another popular measure that people use when they're talking about wealth inequality is to use the Gini coefficient of wealth. And that's basically a statistical coefficient that describes how well wealth is distributed through an economy, with 0 being a society where everybody gets the same income, and 1 being only where one entity has all the income. And so when we take a look at this chart here, this really isn't surprising. At the lower end here, at what one might consider more equal societies, are some of the Nordic nations, where it's been known about the relative equality and tax structure there within these countries, and how wealth is distributed. At the other end of it is the U.S. The U.S. has really the highest Gini coefficient of any developed country, and by all accounts, this is rising. Not pictured there are a couple countries that have higher ones: China, Brazil, and South Africa. South Africa is usually the one, because of its concentrated wealth, is used as the worst case scenario. So the U.S. has this high Gini coefficient, and like any statistical measure, it can be distorted. It can be distorted by demographics, especially here. The large amount of baby boomers just reaching retirement age and the concentration of wealth there, that might have a distorting effect here. However, research has shown that this measure has been rising for the U.S. and really for much of the world overall. And so the subject of wealth inequality and its causes has really made its way out of the economics classroom, or where I first heard about it, and into the popular press with the 2014 publication of Thomas Piketty's book, Capital in the 21st Century. And the thoughts specifically on the rate of return on wealth being greater than the economic growth rate, and the distortions that happen when that occurs. So while one could argue with Piketty's methods and his conclusions, it really got the conversation started. However, there's been a number of really good papers and theories on the possible causes of wealth inequality in the U.S. As well as the world. For the U.S., these theories usually fall under 4 subjects. And the first of these is that the low real interest rates, those are interest rates that are adjusted for inflation, that we've seen for a generation have skewed the risk and reward for investing, and have punished traditional low-risk savers, and that drives them to riskier investments. The rise in the stock market has given a boost to households that held stock market investments, which that traditionally has been about the top third of the wealth distribution. The outperformance of the stock market, of course, has made these individuals wealthier. The middle class, and this is another theory, that the middle class has taken on more debt, specifically housing debt. And that leaves them more exposed to the wealth destruction effects that happen with the decline in housing values, or even a slowdown in the rise, as we saw, of course, with the housing bust about a decade back now. So the increased income inequality that comes from technology and globalization, that's the last area that people are doing a lot of research in. And they believe, of course, that this globalization and technology connectedness, that leads more to a winner-takes-all global economy. And that will lead to declining real wages for the middle class since really about 1990. So the effects of this rising inequality, it sometimes can be hard to directly observe right there in the moment. But over time, when you start taking a look at the statistics, they become more apparent. And the first of these was really a muted wealth effect. Basically, in good times, when people's investments and housing prices have risen, they tend to spend more, fueling the economy. After all, 70% of US GDP is tied to personal consumption. So if the middle class has reduced wealth and the top earners are just saving that wealth, they really don't have as many spending needs as they did, and they're not spending it, we're going to see reduced economic activity there on the upside, sort of a lower high, if you will, for that activity. The second is that economic participants need to feel that they have a stake in a business or economy's upside. The popular press has documented the amount that people have felt left behind by this recent expansion in certain industries and certain geographies, and the effects on public policy and public health. Capital it needs to get a fair return on their investments that increase productivity, but we also need to take a closer look at why wages in lower and middle tiers of income have stagnated or really fallen on that real inflation-adjusted rate. So all this could lead, of course, to a distorted risk-reward calculation in terms of how people invest, how they buy homes, how they save their money. If somebody feels that the economy is a rigged game, that could discourage innovation, that could discourage entrepreneurship, and it could discourage healthy long-term capital formation by households. So a society also needs to take a look not only at the here and now, but really how they develop future human capital. And that is the next generation being given the proper education and tools for the jobs of tomorrow. And that those jobs of tomorrow and that education, that's going to fuel decades more of productive economic activity. And now more than ever, education is needed for a productive workforce, and not only in terms of colleges, but also trade schools. So there's concerns that in the US, the increased tiering of public education and the high cost of college is getting in the way of this. So this issue overall has caught the attention of some of the more forward-thinking people within the investment community. So I always really like to close off when I can with a good quote here. And I can't really think of this one that would be better than this piece by legendary investor Ray Dalio. He posted this on his LinkedIn blog in October. So I encourage you to go read the piece. It's about 10 minutes in length and does a bit more justice than our brief overview did today. But he's right. We need to take a look at keep an eye on the economy of that bottom 60%, and by monitoring what happens both for that bottom 60% and the top 40%, and how their fortunes are either being tied together or becoming more and more disparate, we can make better public policy and investment decisions for ourselves, but also for our country.
Okay, and we're now going to turn it to the Q&A section of today's presentation. Thanks for those concluding comments on inequality, Christian. That's incredibly important and something we'll have to keep an eye on, and obviously look for ways to deal with and moderate some of those excesses as we move forward. You guys can go ahead and use the Q&A box in the GoToWebinar control panel to ask Christian a question. A couple of those were trickling in as we were concluding. One of those, Christian, relates to your opinion on healthcare, specifically your thoughts on dynamics in the healthcare sector within the next 2 to 3 years.
That's an interesting time frame to take a look at it. You know, I think that we're going to have a really large tailwind for the healthcare sector, not only for the next 2 or 3 years, but really, you know, for the next 5 to 10 years. We're going past a certain point where we saw some questions about drug prices, but also questions about how people pay for healthcare. And we're coming out on the other side of this for some of these companies and for some of these investors. So I think that, you know, we talked a little bit earlier that there's some muted earnings expectations. Personally, you know, when I take a look through it, I think that some of those are a little bit underestimating the earnings power of some of these names, especially some of our more innovative pharmaceutical and biotech names, as well as some of our medical device names. here. And we probably will be seeing, as I talked about a little bit earlier, a larger wave of consolidation within the space. As some of these biopharma companies have to go out and replenish their pipelines, they're going to look at smaller companies to go up and buy as well. When we take a look at some of the other parts of the healthcare landscape and marketplace, when we start taking a look, of course, at hospitals, we take a look at managed care organizations, there it also gets a little bit more cloudy. We're already seeing the consolidation happen there. We think of course, about CVS and Aetna, or are we going to see some more consolidation like that happen with some of these insurance players? And what will that mean to hospitals? What will that mean for doctors? Will we continue to see consolidation with those particular names as well, as they find some way to maintain profits, but also be able to maintain a decent standard of care for those that they treat? So overall, I'm pretty positive on the healthcare sector as a group. That's reflected, of course, in some of our positioning in Ajax and our funds. But we do have these issues that we have to be cognizant of.
Okay, great. And just a reminder again, if you have a question for Christian Greiner, feel free to use the chat box in the GoToWebinar control panel. As you do that, Christian, another question here related to a hot topic of late, which is your view long-term on cryptocurrencies, and also as an extension of that, blockchain technology. We've seen those sorts of assets, specifically Bitcoin, sell off of late. Is that a short-term movement? Is crypto a fad, or is there intrinsic value, and is it here to stay?
Well, that's a very interesting question, because we have to talk about what is the intrinsic value of a cryptocurrency. Is a cryptocurrency really just a different way to store value? So when we talk about cryptocurrencies, of course, some of these trading moves that we've seen in these, it's sort of hard really to put an investment case around one of them, or one is better than the other. So we tend really not to do that. The one thing I'd like to talk and tell people when I talk to them about this is that these are still considered speculative investments, that the marketplace is really still evolving here, both from a technological standpoint and in terms of offerings, but really also from a regulatory standpoint. The fact that we now have Bitcoin futures that are trading is going to sort of help the acceptance, but it's also going to help the visibility and regulation of these. The better way to take a look at it from a long term is the promise, of course, of blockchain technology and all the particular different uses for it. Of course, cryptocurrency gets the biggest amount of headlines, but a blockchain and the fact that we could have a decentralized ledger that doesn't have a central authority that is in charge of it, that could be corrupted, could lead to better record keeping and, of course, safer record keeping. And that's really the promise there that we see. And once again, that's a technology that's evolving, and you're seeing a lot of market participants out there in terms of companies really putting their money into technology and divisions that are going to do that. And so for me, that's really the long-term potential there, and something that could be something to invest in.
Okay, thanks. We also had a question come in related to specifically the Azzad Ethical Fund, which is the mutual fund that you manage, and it relates to the fund being underweight. It looks like telecom and utilities, very little in real estate. Do you want to talk a little bit in general, maybe about the positioning of the fund in light of what we've discussed today, and your take on markets in light of the fact that obviously we present you at Ziegler Capital Management with a fairly robust set of criteria and screening as well.
Yes. So when we take a look at a couple of these, the first ones of these are technology. Not technology, telecom and utilities. Within a growth benchmark, we're not going to have really a lot of those. They're just really not there. And then when you add on some of our some of the ethical restrictions that we put on for debt, we have a little bit less that we can take a look at there in terms of companies that we can offer at. With real estate, we're actually pretty close to the benchmark in terms of the mid-cap growth benchmark in terms of real estate. The real estate that we tend to be in, once again, is because of the nature of the fund, is that is lower debt real estate. So, our holdings right now are in, let me take a look at it, a shopping center REIT, as well as something that takes a sort of a look at leisure properties as well. So we do have some holdings in there. As the space becomes more attractive, or if we have some more interesting offerings come through, we do take a look at those. As far as how it's positioned overall, taking a look at some of the themes that we talked about a little bit earlier, we're still overweight tech. We did take some tech off, some overweight from the tech sector off in this last rebalance. We did take some profits there, but we also added to some opportunities in healthcare that we saw there. We still have a slight overweight to the capital goods industry within the industrial space. We added to our materials overweight. So we're positioning ourselves with that late cycle in mind, but also to where some of these opportunities are in mind.
Okay, great. Looks like we have time for maybe one more question here. And it's going to get to a matter related to politics, specifically the possible government shutdown that's looming here in Washington, D.C. Any impact on the markets?
I took a look at this out of curiosity, and so when the government shuts down, and we put that in quotes there, because it truly doesn't, of course, shut down totally. The market goes down about 0.3% in the week after that shutdown occurs. That's not great, but it's not catastrophic. It's you'll see some increased volatility. For me, and for the investment community, what we're more concerned about, of course, is the debt ceiling and the effect on U.S. Treasuries and the Treasury market and the debt market, and how that filters through, of course, to the stock market if that occurs. But this shutdown, while if it occurs, probably isn't good, overall the long-term economic effects of it are negligible. And that's the way that we have to take a look at it.
All right, that looks like our time, ladies and gentlemen, so we're going to go ahead and conclude today's presentation. Thank you again for being with us today. I'd also like to thank Christian Greiner for being here. As a reminder, please visit our website, azzadfunds.com, where you can download and read your free copy of the prospectus for the Azzad Ethical Fund. The prospectus contains more information about the fund's risks, expenses, and investment strategy. While there, you can also sign up to receive our monthly e-newsletter and get more information about our financial products and services. Finally, be sure to follow us on Twitter. That's @AzzadFunds. That's the handle. And like our Facebook page, facebook.com/AzzadFunds. Let me also note that a recorded version of today's webinar will be posted to our website soon, within the next 24 hours, so be sure to take a look. You'll also be getting an email. So thanks again for your time, and have a great rest of the day. Thank you, Christian.
Well, thank you, Josh. And thank you.